welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are talking about the top 10 fastest growth stocks to buy right now, and these companies are literally hidden gems. That's not to say that the stock price of these companies will only go up, however, their growth is absolutely phenomenal, and you may have not even heard about most of these companies. If you are watching this video right now, please go and smash that like button right now for more videos just like this one on the best and fastest growing stocks to buy right now. Subscribe if you are new, comment down below your favorite stock or which of these companies you already hold in your portfolio, and without further ado, let's jump right into today's stories. Now, we're going to be doing something a little different for this video because I am going to point out their PE ratio, which is their price to earnings ratio, and ideally we would want these relatively low, clearly below 50, depending upon how fast the company is actually scaling. So the PE ratios are going to be rather high, however, these companies are rapidly expanding so quickly that they somewhat deserve a higher PE ratio. Also, if you look at the graphs for any of these companies, you can see that they have had explosive growth. Literally, some of these companies have surged over 800% or even 1,800%, but we'll dive into that later in the video. The first company we're going to start off talking about is Palomar Holdings Inc., ticker symbol PLMR. This company is an insurance holding company that is absolutely phenomenal because they have been growing their revenues close to 50% over the last 3 years, and that is extraordinary growth. Anything above a 30% CAGR, which is a compounding annual growth rate, for a very long period of time, such as 3 to 5 years or even more so, means that this company is rapidly scaling. For instance, their revenues totaled around $312 million, which is a huge increase compared to the revenues that they brought in 2018, where they only brought in $73 million. So clearly, this company is rapidly expanding and bringing in more and more revenue year after year. This is so impressive, in fact, that analysts expect the company to pull in around $3.72 per share in terms of their earnings, which is more than double what it managed to bring in for their EPS in 2021. On top of that, their revenue is supposed to explode up to $1 billion for the first time. This company currently trades for $61 per share, while analysts and professionals believe the company should be worth anywhere between $72 and $93, so you could argue that this company is undervalued right now. The next company we're going to talk about is Canadian Solar Inc., ticker symbol CSIQ, which trades for $37 per share, while experts in this field believe it's fairly valued right now because it's trading between the range of $18 and $57. This company has somewhat of a lower PE ratio, coming in at 16.28, so this indicates that it's a better buying opportunity on a value basis because their price is more in line with the overall earnings that they are actually bringing in. Canadian Solar manufactures solar panels in China as China becomes more focused on renewable energy, and this has presented them with a tremendous growth opportunity to where they are also growing their revenue, just like the last company, by more than 50% year over year to $5.28 billion. Their earnings, like I said earlier, are very impressive because it's relatively low for how fast this company is actually scaling. So this PE ratio is quite cheap for a company that's growing at this rate. Investors should also be aware, however, that they have more than $3 billion worth of short-term debt that they are going to have to pay off relatively soon, so that is going to weigh down on the stock price once those debts become due. Overall, their share price has more than quadrupled by 4 times in value since March of 2020 through January of 2021, so overall this could be a solid buying opportunity, but always make sure to do your own research on these companies to make sure they align with your own risk tolerance, your investing style, your age, and your overall investing strategy, because some of these companies will be a good buying opportunity for some investors and not others. So I just want to make you aware of these to at minimum add on a watch list, and at maximum do your own research to determine if these are good buying opportunities for you. The next company we have on our list is Clearfield Inc., ticker symbol CLFD, which currently trades for $129 per share, while professionals believe it's worth anywhere between $120 on the low end and $135 on the high end, and based upon their current stock price, it's trading more toward that lower end of that spectrum. Their PE ratio is in line with the other companies that we talked about on this list so far, coming in at 36, but depending on their growth, this may be too expensive for some investors. This company is a fiber optic optic management and products company, and they have been around for decades. And what's great about this company is that the fiber optic delivery space is starting to grow at a very impressive rate. The company grew by more than a 50% CAGR to $141 million. They also jumped another 50% to where now their trailing 12-month revenue is actually $221 million. Again, another company rapidly growing their revenues and the money that they are bringing in. On top of that, they also have great net margins, which expanded recently alongside of their sales, growing at 178% year over year. Plus, their earnings per share nearly tripled on a year-over-year basis to $1.47 per diluted share. This company is very solid financially speaking. However, that's not necessarily what's going to happen with the stock price, because eventually these companies will pull back eventually. But right now, their companies are rapidly growing their financials and their stock prices are absolutely exploding and surging and skyrocketing. And the next company we have is ticker symbol AMRC, which trades for $63 per share, while experts in the sector believe the company should be worth between $44 and $86. So we could say that this company is fairly valued right now, trading at a price to earnings ratio of 32, again in line with the other companies on this list, as long as it's growing at a 50% CAGR or greater. And in this case, the company, according to their Q3 revenue, grew by 61% year over year to $441 million, while they also presented a generally accepted accounting principles earnings per share of 51 cents per share. And that's actually what they brought in, which means that it grew by 55% on a GAAP EPS basis. This is absolutely phenomenal, and we're highlighting another company that is very strong fundamentally. If you want to know, this company is a renewable energy company, so if you want more exposure to the renewable energy space, feel free to do your own research and look further into this company. Up next, we have Arista Networks Inc., ticker symbol ANET, which trades for $137 per share, which is in line with current estimates, where price targets and price predictions vary anywhere between $110 to $203, with a PE ratio of 37, again in line with the other companies on this list. This company is a data center equipment company, and they grew their revenue by 57% year over year as of Q3 to $1.18 billion, while their net income increased and surged by 58% up to $354 million, while also increasing their earnings per share by 61% to where they brought in $1.13, and that is phenomenal. The company is also predicting revenue growth of 45% in Q4. So again, this company is very financially and fundamentally solid, and I look forward to seeing what you all think about it. A lot of these companies, like I said in the beginning, are somewhat hidden gems in the market that not many investors are talking about right now. Let's break into the top 5 now, and these are the companies that I tend to own. So I do own this company, Lululemon Athletica Inc., ticker symbol LULU, and this company is trading at $360 per share. Now, if you think that $360 per share is too expensive for you to buy, I would highly recommend you look for another brokerage that allows you to invest into companies fractionally or through share slices, because if you have the ability to invest into companies through fractional shares or share slices, you don't need to buy an entire share worth $360. If you have a brokerage that offers you the ability to buy fractionally into various shares, you could buy this company for as little as $1. However, with that being said, this company is fairly valued according to current forecasts because it's supposed to be trading between the range of $200 and $535. If you're not familiar with this company already, this business is a fitness apparel company and they are very successful. The company is currently forecasting another 23 to 24% sales jump on a year-over-year basis in Q4, and this just means the company is going to continuously scale upwards even from now to 2026. So this is very, very impressive, and this is one of the companies that I personally hold in my portfolio, so feel free to do your own research on that company as well, because there is plenty of upside here for this company. Now, considering the current stock market environment, these companies clearly could pull back and stocks don't just go upwards, so you really need to time these investments pretty well, and you need to offset your risk according to their PE ratios, because even though these companies are profitable on an adjusted basis, the companies are still trading at relatively high PE ratios because of their growth rate, this means that investors are betting on the fact that they will grow into their overall market cap as time progresses. And for some of these companies, I 100% agree with that, including this company, which has a very low PE ratio that is only 7, and that is CF Industries Holdings Inc., ticker symbol CF. The company currently trades at $106 per share, while analysts believe the company should be trading at minimum $80 and at maximum $135. Unlike many of the other growth companies on this list, this company is trading at a very substantially cheap PE ratio for how fast it's scaling, and they also have a very nice dividend coming in at a dividend yield of 1.32. This company is an ammonia producer that has been fueled by the rise in fertilizer prices to grow various grains and crops and things like that. And as of right now, it shows no sign of slowing down, to where they are growing their revenues more than a 50% compounding annual growth rate, and that trend is expected to continue onwards. The company is currently pulling in right now $6.54 billion, while their earnings per share nearly tripled up to $4.27. So clearly, due to the Russia and Ukraine conflict, this has superloaded this company with business because farmers need to grow their crops even more efficiently and effectively. The CF share price has actually gained 51% this year, but it still trades at around 7 times their earnings. So this could be a good opportunity for you to get into these companies temporarily. Now, you also need to remember that, are you planning to hold these companies for the long term, or are you anticipating to trade these companies? Because you do run that risk of, if you hold on to them too long, the stock price is going to drop downward because these companies have already grown so much over the last year and a half. But the flip side of that is, if you buy and sell too quickly, maybe over the long term, these companies could continuously keep up with their growth rate. But that is something that you need to weigh according to your own risk management policies. Number 3 on our list is Enphase Energy Inc., ticker symbol ENPH, another company that I have jumped in and out of. The only thing I don't like about this company is that their PE ratio is so high, coming in at 152. The current stock price is trading at $316, while experts in the sector believe the company should be trading between $194 and $363. If you're not aware, this is clearly an energy company, and it's charging full steam ahead, to where it's grown its overall sales and revenue by 7 times compared to what they brought in 2018. And that is absolutely crazy. The company's shares were also trading hands for less than $1 in the middle of 2017. Imagine holding this company at $1 and then it surged up to $316. That is absolutely insane. If this company continues to scale as quickly as they are, maybe they could catch up to their PE ratio, but if I were you, I would wait for a slight pullback in this overall company. In our number 2 spot, we have Horizon Therapeutics Public Limited Company, ticker symbol HZNP, which trades at a nice PE ratio of 17, much cheaper than the other companies we looked at. However, how quickly are they growing their revenues? We want something that's above or around 50% for companies with PE ratios that are this high based on value, because we also want to be cognizant of the value of these companies instead of just focusing on their growth. Right now, the HZNP share price is $77 per share, which is on the lower end of the price predictions that analysts have attributed to it, coming in at $74 to $146. This company has a very impressive pipeline of treatments for various rare diseases, autoimmune conditions, and inflammatory diseases. And we see this growth directly in their revenue and sales, which have grown by nearly 50% to $3.23 billion, while their earnings per share also recovered very nicely, coming in at $2.37. Overall, this is a pretty good company in the therapeutic space. And lastly, we have another company that I personally own in my portfolio, and that is Mercado Libre Inc., ticker symbol MELI. However, we do run into some trouble with a very high PE ratio of 114, but this company is rapidly growing. Essentially, this company is a fintech company, and they are an e-commerce company that absolutely dominates South America. They're like a mini Amazon and a mini SoFi combined, and they dominate the Latin American markets. Right now, the shares have pulled back around 26% this year, despite the company continuously growing their revenues by literally 75% to $7.07 billion. And they're actually on track right now to deliver over $10 billion worth of sales this year. And that is very exciting. But overall, the company is expanding extremely impressively. This is an amazing company. They're growing their operating income by nearly 5x, 5 times, and they grew their gross profit by nearly 3 times to where it came in at $4.56 billion over the trailing 12 months. So overall, there are some real gems in this video, but I encourage you to go and do your own research to make sure these companies align with your personal portfolio. But what do you think? I would love to hear your thoughts down below on any of these companies, or even a company that should be on this list. Remember to go and smash that like button if you haven't already, subscribe if you are new, and I'll see you in the next YT video.